Hey everyone, it is Evan here from the Trade Risk on Tuesday, February 5th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So we're going to jump into our dashboard here. You can see we're off to a great start to the week. Once again, we're green right across the board today, about 0.5% in all of the major averages. And the 5-day change, take a look at some of these numbers here. Very impressive numbers, 3 to 6, almost 6% in the Qs. The Qs certainly what's been leading the market or driving the market higher on this latest leg. And when we look at how these major averages are doing versus some moving averages, you can see we have now reclaimed just about everything on this board. One thing to note though is that the 200 SMA calculation on this dashboard is using total return data. So that means it includes dividends. If you're looking at the unadjusted data, we are not quite above the S&P 500. If you were to look at it in TC 2000, for instance, we are still below the 200 SMA. If you were to look at it by default on stock charts, we're above the 200 SMA. So there's a slight caveat there. You should always understand where what kind of charts you're looking at, total return or not. In this case here, this is total return numbers. If we go down to some of the sectors here, you can see it's technology, semiconductors, industrials, all leading to the upside here, really getting that rotation to give this market that next leg higher. Financials, materials, healthcare, they are the bottom of the pack right now for 5-day performance. When we go to major markets, we have international. So we have China, we have emerging markets, and then we have S&P 500, we have high yield, a really sort of good blend here of risk assets seeing rotation to the upside. Certainly doesn't mean we should go get all excited at these levels and buy everything, but it certainly shows the extent of which this market is continuing here, that froth building, so to speak, but the market can't fight it, is still moving higher. On the downside, we have natural gas and volatility still unwinding. So when we get into some of the charts here of the S&P 500, this is where we like to start our analysis on a weekly time frame. And by the way, I did a video yesterday with a long-term look at all of the major markets. You can check that out, try and link it up here now, or just look on the YouTube channel. I think it's should be the last video, but a real monthly depiction look of all the major assets, which I think is interesting, kind of gives you that top level view. But in these videos, the sort of hand-to-hand combat of day-to-day price action analysis, the weekly is generally as big as we'll look, and this is the weekly view of it. And you can see with the now looks like 8th week higher off of the lows here, 1, 2, 3, 4, 5, 6, 7th week in a row, 7th week in progress here off of the lows made down around 23.46. We've come an outstanding 16.5% rally off of the lows here, and as much of a straight line as you could really imagine. And the S&P 500 is basically on pace to put on a full 100% retracement. It's not there yet. It's at about the 80% mark. But if you were to mark the 27, call it 27.90 as the place where price started to really roll over and put in this nasty leg lower at the end of December, we are very much approaching it. We're in fact just about less than 2% away from putting in a full retracement there, and at that point we would start to invalidate the series of lower lows and lower highs we have in place on this weekly time frame chart. So bulls just continue to repair damage here. Again, 17% straight line rally. You have to question whether or not you want to be chasing that. That all depends on your time frame and strategy, which we certainly cannot speak to in this video, but the relevant levels that we can be paying attention to is certainly above us now. This 2795, 2800, nice round number here. That's where the market struggled and peaked out all through September, October, November, and rolled over in December. That's where it looks like we're headed. Certainly don't have to get there, but the market stays resilient and pent up in this trend like it has been. It'll be another week or so at this pace before we're there. So we'll see if they get there, but that's what we're looking at. On the downside, it looks far away at this point, but 2600. That's the big relevant level that I'd be paying attention to on the downside on this weekly time frame chart. Now, if we go a little bit closer, we take a look at the price action here. We'll switch it over to the SPY ETF and we take a look at some of the levels a little more closely. We can see we are coming now back into another level that was of prior influence around 273.80. We can see price stalled out there back in November and October in this chop a few times. I think even earlier in the year as well. That had been where price had seen some influence. So we're coming into that level, and then right above that is a little air pocket all the way up to 280 in the SPY ETF. Now, in our last couple of videos, what we're talking about was staying above, moving our sort of line in the sand. Let's see if this chart's a little less busy. But moving our line in the sand to this here, this little rectangle breakout that we saw last week on Wednesday, Thursday, that would be where we wanted to see the market hold above to keep the momentum, to keep this as pent up and strong as possible. We want to see the market hold above 267, and it has done that so far. That to me is still pretty much the most relevant level that I'd be looking at this market to stay above. You could certainly draw your trend lines in here of a slightly, quicker slope on an intraday basis if you wanted to use that. And then of course, I'm always a fan of looking at taking out prior day's lows as being a potential turning point. And for now, we're not getting any of those things. It is still just a bull parade to the upside. So 278, 280 or so. We also have this small level here, 273.80. Those are the levels I'd be looking at on the upside. And then on the downside, I'd say around 267 or so. Those are the near term kind of horizontal levels that I would be watching. Now, really, as sort of just mentioned there, SPY, there still seems to be no cracks at all. Certainly, again, chasing this is a very tough proposition at this point, but make no mistake, it is the bulls that are getting paid. People that have chased or people that are holding are still the ones getting paid in this market. So it has paid to stick with this trend as tough as it may have been. One thing to note here, just to try and throw in a little bit of the kind of uncertainty there, is volatility trying to put in a little bit of a stage of a rally here off of the low 15 levels. And occasionally I like to look at the VVIX, which is kind of the VIX on the VIX, the volatility of volatility. I know it gets a little bit abstract there, but you can see a nice turnaround here saying that the demand for volatility is actually increasing at these levels. At this time, again, no signs of cracking or any type of deterioration in price action, so take from that what you will, but it is something at least worth noting for you very small or very active traders on smaller time frames. We go to some of the other major markets here. We'll go to IWM next, which you can see again is just continuing to levitate higher. I still like to look at this market here for a potential kind of leadership or early signaling, if you will, on some of the rest of the market. In our last couple videos, we talked about 147, the top end of this range, being our upper level line in the sand, and we'd want to see the market stay above it to act as strong and resilient as possible. And we are still holding above it, and the market is still acting strong and resilient. So until and if price action breaks below this 147 and change, I'm going to say bulls continue to have a good firm hold of this market, and it looks like we're again on pace to kind of retest and put in a full retrace of the December pivot here up around 154. Finally, we got the Nasdaq 100, which continues to power higher as well. MACD making new highs today as well. Very quickly coming back into the higher pivot high here in December, up around 172. It has certainly battled with and cut right through all of this prior kind of sideways range in here for the Qs from the last quarter of 2018. And it is getting a little bit vertical here. We are getting a little bit frothy, to say the least here, maybe in the short term. But again, it doesn't mean anything until it does, until we get an actual price reversal, high volume outside day, something of significance. This trend does continue to remain to the upside as well. So that is the market overall. Let's jump into some of the other majors here. You can see TLT still just comfortably moving sideways, which I, for one, am happy with, because this to me is setting up for a range expansion, if you will. Yet to be seen whether or not that's to the downside below 119 and change, or if it's going to be to the upside of 122.50 or so. But it is certainly worth watching here. A little bit of uptick in volume over the past 3 or 4 sessions as well. So interesting to note, but I'm watching this range. Nothing to do at this point for me until we start to get some resolve. USO tried to break out early or late last week on Friday. Was starting to break out from this pattern here, and you can see it kind of just rolled back over and is kind of comfortably moving sideways here. It seems content to trade around this 11.25 level. So USO still waiting to see what happens here. Still mostly sideways with a gradual tilt to the upside, but really nothing else has changed. And finally, or actually not last but not least, is natural gas, which is back to and actually undercutting the January lows here. So we have new, fresh year-to-date lows for natural gas. Maybe this turns into some wedge that explodes to the upside. Natural gas does have some extreme volatility at times, so don't count it out, don't sleep on it, but at this point, it is making new lows. The trend is to the downside. It's tough to get too excited about this until and if it starts breaking and taking out some prior highs. Until then, nothing of interest to me there in natural gas. Last but not least, our metals. GLD here, which you can see on the week, is about flat, an inside week kind of brewing here for GLD. It's pulling back off of the highs a little bit. It's enjoyed a great run, a little bit of pullback here and reset or consolidation through time. Certainly would not be the worst thing, but GLD pulling off just a little bit, and silver pretty much in the same situation here. It's 3 or 4 days off of the highs made last week on Thursday. Again, it's had a nice run to the upside. It still has a nice well-formed uptrend in place. Personally, probably biased because I still have a position in this, of course, which we talked about our entry in last week's video, but it was early last week when we got involved in it. So we still have the silver on, sitting with it, sitting patient and looking for this trend to eventually resume, but I'm fine with a little bit more of a pullback or sideways consolidation. I do think ultimately it is healthy price action. So that is it. That's what I got for the midweek video. Thanks so much as always for tuning in and watching. You can subscribe on our YouTube channel or head to thetraderisk.com/blog. You can catch all the latest that we're publishing on the blog on the Trade Risk. So thanks so much. Have a great rest of the week and talk to you again on Friday.